The ETF Investor's 2026 crystal ball starts with one simple reality. The next market cycle won't reward passive complacency. Structural shifts in technology, energy, demographics, and geopolitics are accelerating, and ETFs are where those themes will express themselves first. Today, we're looking ahead to 2026, identifying the most disruptive investment themes shaping the ETF landscape, the risks investors can't afford to ignore, and 5 ETFs that may benefit if these trends continue to play out. This is not about short-term hype. This is about positioning for the next phase of global markets. The first major theme is AI infrastructure. The AI boom is moving beyond software and headlines and into the physical backbone of the digital economy. Data centers, cloud networks, semiconductors, and power-hungry compute systems are becoming strategic assets. As governments and corporations race to secure AI capacity, demand for infrastructure will likely outpace supply. A potential ETF exposure here is the Global X Artificial Intelligence and Technology ETF, ticker AIQ. This ETF offers diversified exposure across AI hardware, software, and infrastructure providers rather than betting on a single company. The upside is long-term structural growth, but the risk is valuation compression if AI spending slows or expectations reset. The second theme is energy transition realism. The market is moving past idealism and toward pragmatism. Renewable energy growth continues, but grid reliability, battery storage, and transitional fuels are now front and center. Investors are realizing that the energy transition is not linear and not purely green. One ETF aligned with this shift is the iShares Global Clean Energy ETF, ticker ICLN. While volatile, it captures long-term renewable adoption trends across solar, wind, and energy infrastructure. The key risk here is policy dependency. Subsidies, tax incentives, and political shifts can dramatically impact performance, especially outside the U.S. The third theme shaping 2026 is defense, security, and geopolitical risk. Rising global tensions, regional conflicts, and defense spending commitments are reshaping government budgets. Security is no longer discretionary spending. It's becoming structural. A targeted ETF here is the iShares U.S. Aerospace and Defense ETF, ticker ITA. This fund provides exposure to major defense contractors and aerospace firms benefiting from long-term military contracts. The risk is headline sensitivity. Peace talks, budget delays, or political pressure can cause sharp short-term volatility even in a long-term uptrend. The fourth theme is reshoring and supply chain resilience. After years of globalization, companies are rethinking where and how they manufacture critical goods. Semiconductors, industrial equipment, and logistics infrastructure are being pulled closer to home. This trend favors industrial automation and advanced manufacturing. An ETF positioned for this theme is the Global X US Infrastructure Development ETF, ticker PAVE. It captures companies involved in construction, materials, and infrastructure modernization. The opportunity lies in multi-year government spending programs, while the risk comes from interest rates and cost overruns that could pressure margins. The fifth and final theme is income evolution in a higher-rate world. Even if rates eventually decline, the era of zero rates is likely behind us. Investors are increasingly focused on sustainable income, downside protection, and cash flow resilience rather than pure growth. A strong ETF example here is the Schwab U.S. Dividend Equity ETF, ticker SCHD. It emphasizes high-quality dividend-paying companies with strong balance sheets. The trade-off is underperformance during speculative rallies, but it may shine during market drawdowns or periods of economic uncertainty. Now, let's talk about the risks that could derail even the best ETF strategy by 2026. Regulatory risk is at the top of the list. Governments are increasingly involved in markets, especially around AI, energy, and data privacy. Regulatory shifts can instantly change the economics of entire sectors. Geopolitical instability is another wildcard. Trade wars, sanctions, regional conflicts, and currency disruptions can create volatility across global ETFs. Diversification helps, but it does not eliminate systemic risk. Valuation risk also matters. Many thematic ETFs perform best early in a cycle and struggle once expectations are fully priced in. Buying the theme is not enough. Position sizing and timing still matter. Finally, liquidity and concentration risk should not be ignored. Some thematic ETFs hold narrow baskets of stocks, which can amplify volatility during downturns. Always understand what you actually own. The 2026 ETF landscape will reward investors who think in themes but act with discipline. Tactical rebalancing, diversification across uncorrelated trends, and a clear understanding of risk will matter more than chasing the next headline. If you want more forward-looking ETF analysis and real-world portfolio insights, subscribe to the ETF Investor, and let me know in the comments which theme you think will dominate the next market cycle.